Hey, what's going on YouTube? In this video, we have Fox Corporation, ticker symbol FOXA, and we'll jump right into it. What we're going to kind of do is we're going to go into mostly just financial work today and just kind of see how the company has performed financially. And then because this company we can see right here as positive EPS forward looking, and I think it's positive EPS currently anyway, see, what to expect for a price tag on this company, along with the financials and along with a little bit of technical analysis as well. So, first things first, we can see we are positive EPS. We do have a little bit of a dividend yield and about 4% short interest against the company right now. And on earnings, they reported November 2nd. They beat on revenue, but missed on GAAP actual EPS, but beat on EPS normalized actual. And then EPS revisions on analysts, majority have revised their expectations higher for this next quarter. We come down here to our expectations on EPS. We can see in the next quarterly report here, we're expecting, at least there's probably guidance of some kind that is telling analysts that, hey, we're going to be close to a zero for our EPS expectations next quarter. But going forward, we're going to see our EPS get back to normal and then continue to potentially grow. As at least that's what analysts are forecasting and expecting in the coming quarters. So that'll be, I think, next quarter, probably just get looked past and just to make sure that guidance is going to say, hey, we're going to get back to where we used to be. So I think that'll be a pretty important earnings report when that does come out. So over here to our financial spreadsheet, we do have revenue gross profit, which is 100%. Gross profit is 100% of revenue, which is why we don't see the blue line. But we can see revenues continue to climb year over year, which is very good. But our net income's pretty flat. They don't really seem to they're not really growing. If anything, they are starting to shrink. And we can come over here to net income and we can see how that is performing. We can see it's just kind of slowly trending lower. So that's something that is not ideal, especially when you got growing revenues but declining in net incomes. And we come here to net margins, though. Their margins have increased last quarter, but over the course of time here, our trend is lower. They have had a couple 2 years here that appear to be out of the norm, but overall margins do trend lower as of right now. They can maybe, obviously, last quarter was pretty good for them, and maybe they are going to get back into a 12% margin range, maybe even, at least in the low teen margin range again. But that is something we'll have to wait and see if that actually comes. So return on invested capital, same thing, in a bit of a downtrend here, sitting at 5%. Our PE ratio on the business is sitting normal at about 15, is probably a pretty decent average, 14, 15 on the PE ratio there. Earnings yield sitting at 7%. That's pretty good. We got cash to short-term debt. Company does have more cash and short-term debt, but not by much. Another thing too is we can see declining cash position as well. And we come down here to our cash to total liabilities. And again, here's our cash position in the blue. Cash is declining, whereas total liabilities are slightly declining, but really, they're not really. They decline a little bit, pop back up, decline a little bit recently. So I would say liabilities are not really moving. Then we got our net income to free cash flow. Again, net income and free cash flow both in the same direction and a trend, which is lower, not really ideal. You got free cash flows here. Again, we can see it's going lower. That's the data. That's what we got. So net income, revenues are growing, net income's not, and free cash flow is also declining. And then we got capital expenditures. We're actually kind of flat. So our CapEx is pretty flat, but we still have declining free cash flows. And then our share count dilution, they do buy back shares, and we can see that the overall share count has been reduced quite a bit over the last few years. They got up to a height of 621 million shares, and since then have bought back 130 million shares there. So that's pretty good. And they do offer a dividend. Doesn't seem to be much of a grower for dividend here, but you can see they went from 46 cents, 47, 49, 51. So they are a little by little growing their dividend. Although if their cash flows continue to decline, I don't know that I'd want to see a dividend payout, because then they're going to start using more of their cash than they already are to pay out this dividend. So that is something to probably keep an eye on, make sure. Dividends are great, but at the end of the day, you want to make sure the company can afford to pay out that dividend. So now let's jump over to the 10Q, break down these financials just a little bit more in the most recent release. And we're going to come over here to our revenues. We want to see if there's any big changes or any concerns that the business is doing within these financials. And So we got our revenues here, and this is over the course of 3 months, year over year. And revenues year over year basically flat, but with flat revenues, we can come down here to net income and we can see we're down $200 million. And a big chunk of that is operating expenses. Yeah, operating expenses are up. We've got SG&A is up. The rest of these are pretty flat. Other is slightly up as well. And that's causing us to see a big reduction in our net incomes. That those are not things you want to see. You want to see these, if anything, you'd rather see less revenue but more net income. If there was if there was something to see, that the business is able to cut costs, but and make less money, but ended up bring more money to the bottom line. So then over to the balance sheet, we got, companies currently burning through cash. We can see the way they had $4.3 million. This is as of June. And then just from June to September, the company burned through about, call it $400 million or a little bit more than that. $450 million. Not ideal. You don't want to see a company burn through cash, and we probably want to figure out exactly why or what's causing that. And obviously, we can see EPS next quarter is going to be pretty low as well, so we're going to expect more cash burn after the next quarter. Onto our cash flows, we got last year did 613 million. This most recent report this year in the 3 months span, $415 million. And after we have depreciation added in, you got stock-based compensation, and then some other changes to the balance sheet, we are left with $1 million in overall cash flows last quarter here. And prior quarter, this time last year, they did $270 million. And then you got your CapEx down here, which is about $70 million. So basically, you're left with negative $70 million in free cash flow last quarter. And this time last year, they're positive about $196 million. So big difference year over year there in cash flows. And then you come down here, we can see company did buy back more shares, issued out dividends, left them with negative $386 million. Then you add in, your cash used in investing activities. You subtract basically the company lost $443 million this time last year. And then last year, company lost $250 million. Basically, that was just the cost of their repurchase of shares. So again, company is burning through cash. It's not a significant amount, but one thing to keep in mind though is once we come back up to our balance sheet, we want to see, okay, a company's got $3.8 billion in cash. Short-term liabilities is sitting at $3.6 billion. So you've got about $200 million left over. These short-term liabilities will need to get paid in the next 12 months. So 12 months of time, this has to get paid. And then obviously on top of it, you're burning through cash on your cash flows as well. So you're burning through $443 million. So company's got about 1 year's left of cash left until it needs to raise more capital or something else happens within the business. Obviously, company still makes money, so it shouldn't be too big of a deal. I think it'll be just fine, especially once those EPS start turning around, which analysts are forecasting in this one. So I think this one's a little bit of a risky play at the end of the day here because we're burning through cash. Cash flows are negative, revenues are growing, but net income is not. So I think there's some red flags within this one. Something that I would stay very cautious with on this one. Keep a light position if you are in it. Personally, that would be what I would personally do. But let's jump over to our comps. We have I found Paramount as a competitor, so we'll just compare FOXA to Paramount here, and we come down here to our margins, market cap to revenue. Paramount does a lot of revenue in comparison. And then we've got down here our other margins, gross margin. We'll ignore that for now. But we come over here to operating margin. Paramount is not able to turn a profit. So Paramount is not a profitable company at the moment. Free cash flow, again, free cash flow, Paramount not positive there either. Return on invested capital, pretty good on, Fox in comparison. So in just the quick comparables on these few numbers here that we're looking at, Fox is definitely the one you'd want to probably put your money into if you wanted to invest into this industry. And also you can kind of see this on the stock chart here. We can see this is just in a downtrend over the course of the last like 4 or 5 years here. And Fox is pretty flat, going back to 2019. It's pretty much, in the last 5 years, it's just traded sideways. It hasn't gone up or down. So there is some consistency in that, but obviously, I think the financials have to start turning around if we want to see this thing start to maybe begin a new uptrend. But if financials don't seem to turn around, the stock chart will follow the financials eventually. So over here to our valuation spreadsheet, now we can figure out what this thing is worth. So Peter Lynch Valuation gives them $36.67 per share. Multiples comparison, because Paramount is not a profitable company, we have no comparables on this one. Manual PE, it take this company about 14 years to earn its current market cap, so it's not too bad there. Price to book, we don't have a 5-year average on the price to book at the moment. Graham's valuation gives them intrinsic value of $50.11. Our dividend discount model is $32.67. We come over here to our DCF. So this one, what I did is analysts have a growth rate of 6%. The average growth rate is 8%, but forecasting, I don't know that 6% is a fair number. So I think what we want to do in this one, just because of how the financials are trending, we'll give them like a 2% growth rate on this one. And we'll have to see where it goes from there. But just based on the trend of the free cash flows right now, I have to assume free cash flow is not going to grow unless something changes. When we come down here to Rule 72, we have 3 sources of an EPS growth rate for an average of 13% growth on EPS. That gives us about a 1.76. So our future EPS is going to be around 7 based on those numbers, because we get to double our current EPS 1.76 times from where it is now. That puts us right around in this range here. So that gives us about a 7. So that gives us a fair value today of $44.29. So the final valuation on Fox Corporation is $44.80. 30% margin safety is basically where it's trading now at $31.36. And analysts do have a price target on this one at $34.80. So we are a little bit higher than where analysts are forecasting. And when we look through our summary up here of our valuations, every single one of the valuations that we went over is higher than where the price or where the stock is currently trading. So it kind of gives you an idea that this could be an undervalued play. Obviously, I think it's undervalued because the financials are not where they should be. So analysts are probably kind of on the sidelines on this one until they maybe start to see the financials start to turn around. But this could be a pretty good short-term play, maybe not necessarily a long-term play, but something that could be played, for like a swing trade, something like that. So over to our stock chart real quick. So I've got this yellow trend line drawn in. This is our downward trend line. Obviously, I've cut out a few tails. It's not a perfect trend line, but I've tried to tie everything in that I can. This is how I would normally draw. You can draw it out to here, something like that, but it's still not that ideal. But I'm going to tie in as many tails as I can. And then we've got this upward trend line as well. We've got this orange line. You can draw it in like that. It seems to me like that was a potential trend. It seemed to consolidate on it again right here, broke through, landed on support, is bouncing off support, might retest this orange line, and it might just channel out here for a little while. Again, this is all going to depend on financials. Honestly, I think it just depends on what the business is actually going to do in the future. And we know next quarter report is probably not going to be anything great. They're already probably expecting it. And if it comes in better than what is expected and their forecast is better than expected, you might see this thing pop back above this orange line. Otherwise, if it comes in as expected, it's probably just going to chop around here for a while, maybe finish out this yellow wedge. And then to the next quarter, we might see a breakout either this way or a breakdown that way. Again, it's just going to really depend on their financials based on what we just went over. But that is it on Fox Corporation. If you found value in this video, drop a like, subscribe, comment. We'll be back later with another stock analysis video.